The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
Well, you heard it from Warren himself. The first rule of investing is not to lose money. However, all of us as investors will at one point or another break Warren Buffett's first two rules. Understand that your goal as an investor is not to try and never make any mistakes, but you want to try and avoid them as much as possible, especially significant mistakes that can cost a lot for your portfolio down the line. With this in mind, good investors take the time to learn from their past mistakes to make sure they don't repeat them again. However, the very best investors learn not only from the mistakes that they have made themselves, but also from the mistakes other investors have made as well. You see, there's no need to repeat the mistakes of others just so you can have the personal experience yourself. So today I'm going to share some of my investment mistakes that I've made throughout my investment career over the last 6.5 years or so. This will give you a few lessons on some mistakes to avoid at different stages during your investment career, and will also provide a little bit more backstory as to how I got started investing and what I have learned along the way. As a disclaimer, this video is not intended to be a list of the most common or most severe investment mistakes. It's more of a documentation of my personal investment mistakes and the lessons I've learned from them. With that being said, I hope you enjoy and appreciate the transparency with this video, and by the end of it, come away with a few lessons learned. So let's begin with a little bit of context. So I'm 25 now, and I started investing 7 years ago when I turned 18 in 2011. Over that 7-year period of time, stocks have been in a bull market, which is generally rather forgiving for newer investors. For instance, in 2007, many investors were feeling like they were making all the right choices, but their mistakes only became apparent once we saw a bear market. That being said, there's still plenty of mistakes you can make during a bull market, especially if you're a newer investor who doesn't really know that much starting out. This was the case for me when I turned 18, still in high school and interested about the concept of investing and compounding my money, but not familiar or even aware of the intricacies and nuances with trading stocks and stock valuation. However, like most young investors, it doesn't stop them from getting their feet wet, which is exactly what I did as soon as I turned 18. However, I was at least aware of the impact that fees could have on your wealth, so one of my first investments was simply a low-cost index fund. Looking back, I don't have any issues with this decision, and it wasn't until I would say probably the second half of 2012, or my first semester in college, where I really started my first investment mistake. And this is when on August 6th, 2012, I bought 5 shares of an exchange-traded fund, BLV, for $97.79 each. Now, BLV is the Vanguard Long-Term Bond ETF. Now, what attracted me to this fund initially was the fact that now that I was earning a little bit money through work study, that money was earning no interest in the bank, because remember, at that point in time, short-term interest rates were effectively zero for that period. I was looking for a less risky, in my mind, option where I could earn some additional interest. That's when I saw the long-term bond ETF, and this is the current SEC yield right now, roughly 4.3%, but this is similar to what I remember the yield being when I looked at it in 2012, roughly around 4%. In my mind, the way I was viewing this was, well, 4%, that is a heck of a lot better than 0% sitting in the bank, so I'm gonna take some of my extra cash that's just sitting there and invest it into this fund. Now, there's more than one reason why this was a mistake, but we'll go over what actually happened as a result of this purchase. As it turned out, I bought this fund right around its multi-year peak that occurred during that summer of 2012. At the time, I didn't fully understand the implications of what the difference was between a bond fund and just regular cash. I understood that bonds were riskier than cash, but I didn't connect that to the economic situation we were in at the time. You see, at the time I bought this bond fund, long-term interest rates on bonds, in this case we'll be measuring by the 10-year treasury yield, were at the single lowest point over the last 60 years. And since bond prices move inversely or opposite the moves in interest rates, this meant that if interest rates rise above these historical lows, that my bond fund value will go down. And as it so happens, that's exactly what happened next. My mistake was thinking that this yield, this 4% yield I was getting on this fund, was going to be my actual returns from this fund. I didn't understand the significance of a rise in interest rates, which would bring down the value of the fund even more than the dividends I was receiving. So what actually ended up happening was 6 months later after I bought this fund, I ended up selling out at a loss of roughly 6%. This was in January 2013, as rates had already begun to rise, but would end up continuing to rise significantly further throughout the rest of the year. I sold because I was unhappy that even after receiving dividends from the fund, I was losing money overall because of the declines in the share price of the fund. I learned from that mistake and became a lot more knowledgeable at bonds and their specific risks after that. I've done an older video on bonds if you want to check out, which covers some of those basics. What's funny and actually kind of interesting is that you can still see the implications of this mistake on my investing decisions today. This mistake made me acutely aware of the interest rate risk that long-term bonds have, and as such, currently my portfolio does not have any long-term bonds. Now, this isn't because I'm afraid of them, but I understand the risks much more now than I did back then, and at this point in time, I don't believe it's an attractive risk to reward opportunity. Given that I didn't have a lot of money at the time, that mistake cost me about $40, but I will say that was a $40 very well spent because that was a very valuable lesson. The next mistake unfortunately costed a little bit more and in hindsight looks pretty dumb. However, I will say that is one of the benefits of at least making mistakes early is that you don't have as much to lose. Learn from your mistakes early on, learn from other people's mistakes so that later down the line when you have more money in the game, you're less likely to make a big blunder. So in this mistake, I botched my investment in Apple. So this is a 7-year price chart for Apple, and I first bought shares in September of 2012. For context though, here's what the 7-year price chart looked like when I actually bought the shares. At this point, Apple looked like an unstoppable stock and money-making machine. I vividly remember going to the library that first semester and seeing all the Macs and seeing everyone on their iPhones and thinking, this has got to be a good investment. Now, spoiler alert, over the long term, it absolutely was. However, in the short term, you can still see price declines and stock volatility. And that's exactly what I saw over the preceding 6 months with Apple stock. See, this was the first time we were seeing concerns over slowdowns in the growth of iPhone unit sales. There's talk and discussion about this about Apple today, but this was the first time this was a more serious concern for Apple. Again, at least in the short term. With that, Apple shares from September to March were down roughly 30%. And so what did I do? Well, you guessed it, I sold my Apple shares in mid-February of 2013 for roughly that 30% loss. Now, had I actually kept those shares for the long term instead of selling when I did, I would have been up almost 200% when you account for dividends. Now, what were some of my mistakes with this? Well, first off, I got too caught up in short-term news. When investing, it's oftentimes beneficial to have a long-term mindset and tune out a lot of the short-term noise. This is because, as was the case with me early on, I got emotional when I saw both the negative news and negative price action on the stock. This can crush the confidence of new investors, cause them to doubt the reasons why they initially bought the stock in the first place, and make them sell when they probably shouldn't. Generally, as a rule, I try to own every stock for at least a year to benefit from the long-term capital gains rate, but most of them I have the intention of holding even longer than that. Another big lesson I missed, which in hindsight is an obvious no-brainer buy for Apple, is its valuation. Now keep in mind, I was not aware to any degree to the extent that I am now of stock valuations when I was first investing. When I sold those shares, Apple was trading at a price to earnings ratio less than 10. Now this is a low valuation even if you don't take into account Apple's growth prospects at that point. However, when you include the strong growth prospects, Apple is clearly undervalued at that point in time. Activist investors saw this, and that's part of the reason why Apple kickstarted their buyback program to return capital to shareholders and bring shares to a more fair valuation. Having sold out early, I missed all of that. Now the loss on that trade was roughly $850 or so, but if you include the opportunity cost of those lost gains by not holding the Apple shares, it's a total loss of roughly $2,000. In the grand scheme of things, it's not terrible, but that is one I'd rather have back. So that covers my first few years of investing, and I'd say probably the period from 2013 to 2015 was not particularly eventful in the sense that most of my investments at that point were reverted back to more traditional index funds. In this case, this is just a graph of the Vanguard Total Stock Market Index ETF, ticker symbol VTI. So I was invested in this until roughly 2015, when in August we saw our first bout of more stock market volatility, in which case I actually sold out partially because of the noise from that volatility, but also because I was concerned that stock market valuations were being artificially propped up by central bank easing. Now in hindsight, one can easily say, well, that was obviously a mistake because if you look at the performance over the next 3 years or so, you missed out on a lot of gains there. Though trying to look back with an honest perspective, I don't think this was likely the biggest mistake I've made because, well, the decision was made maybe more, or at least triggered by emotions on the sudden price movement that we saw that August in 2015. The thought process, logic, and reasoning behind actually selling had been in the works for some time, namely higher valuations relative to historical norms, as well as concerns over central bank easing and their zero interest rate policy. That's why I'm including it here for transparency, but I'm a little more hesitant about calling it a true mistake. You can let me know your thoughts in the comments. Do you think this was a big mistake, or was the reasoning justified? An analogy for me is like you're trying to get to a destination and you're a little bit late. You can either continue driving the speed limit, or you can speed a little bit or a lot to try and get there faster. In the case of going the speed limit, you're taking less risk, but you are likely going to get there late. However, when you're speeding, you're increasing your risk of both getting a ticket and getting into a serious accident. Now, given where valuations were in 2015, we were speeding and I wasn't really comfortable being in the car at that point. However, of course, after I stepped out of the vehicle, Mr. Market, who was driving the car, proceeded to floor it in late 2016 and 17, bringing market valuations to their second highest point in history, only to the dot-com bubble. So that's the context for that decision, and you can decide for yourself whether that was a true mistake. At that point, the question is, what do you do with the funds then? So one thing that I was looking at prior to even 2015, but definitely even more significantly following that August, was gold. Now, I've been meaning to do a video on gold for some time now, and I'm hoping that we can do it this week, but don't hold me to that. I'll try my best though. Either way, with gold at multi-year lows at that point in late 2015, it looked like an attractive hedge to what my primary concerns were at that time, which were these large central bank asset purchases effectively printing money into the economy, which could potentially spur inflation. Now, in the short term and for minor inflation, gold doesn't necessarily serve as a great inflation hedge. However, when you see periods of high inflation rates, gold does a very good job of holding and storing its value. Given that in late 2015 and early 2016, my portfolio was primarily cash with a concentration in gold-related stocks. Now, the timing for this just happened to work out. It was certainly possible that gold could have continued falling before we saw any positive price movement. Either way, I hope that gives a little more context over the trading history during that period, and this will help lead into my next mistake. And this next mistake deals with another exchange-traded fund, in this case, the Vanguard Emerging Markets Stock Index Fund. Ticker symbol VWO, this fund saw a sell-off from September of 2014 through January of 2016. As I didn't have a significant allocation in my portfolio to stocks at this time, this looked like an attractive opportunity to maybe get some exposure there. I ended up buying in March of 2016 for roughly $33 or $34 per share. I thought that the share price could get back to $40, which seemed like a reasonable value for the stocks in the fund. So when the fund's share price went over $38 in August 2016, I ended up selling out of my position completely there. Now, while this is a 15% gain over about 5 months, I underestimated the amount these stocks could rally to and beyond what I thought was a fair valuation for the fund. Had I held those shares for an entire year, I would have benefited not only from the long-term capital gains rate, but I would have realized a roughly 36% return on that investment compared to the roughly 14% that I actually achieved. So the mistake here is I definitely missed out on the upside or the opportunity cost of selling early and missing out on those gains. Given the recent price action over 2018, in which case shares are down by roughly 25%, it does seem like these shares overran their true fair valuation. However, that being said, with a little more patience and adherence to my 1-year holding rule, this would have been a much better investment. The idea was there, but the execution was just a little premature. So for context here, effectively starting late 2016 and going through all of 2017 and 2018, I've been much more focused on identifying value within individual stocks rather than using index funds. Now, this is for several reasons, one of which is I think a lot of index funds right now are simply overvalued relative to historical metrics. 2, since graduating college and starting work, I now have a lot more capital and cash on hand that makes investing in individual stocks more economically feasible. Especially before Robinhood, which offers commission-free trades, was publicly available in the US, it didn't make a lot of financial sense to try too hard to invest in individual stocks and companies when you have to pay commissions every time you buy and sell stock, even if it's a relatively small order. When you don't have a lot of funds, those commissions can really eat into your capital, which is why investing in no commission, low expense ETFs and index funds can be a fair investment option for those who don't have a lot of capital starting out to invest. Now that I had some more capital, investing in individual stocks looked like a better risk to reward opportunity for me than index funds at that point in time. So I've discussed many of those stocks I've been invested in, am invested in, or considering investing in on this channel, but one I have not discussed is a previous mistake I made with the stock of Foot Locker. Foot Locker initially caught my attention in 2017 after a sudden price drop, which looked like a delayed reaction of the retail apocalypse. Now, the investment thesis for the retail apocalypse trade is to sell all retail stocks because Amazon will completely dominate the market. Those who aren't completely sold on this premise might find some value within these beaten down retail stocks. I found success with this investing in the retailer Kroger after the Amazon Whole Foods acquisition announcement. Now, I initially entered a small position in Foot Locker, roughly $3,000 at around $45 per share. I thought the shares were a reasonable value at this price, but I misjudged the margin of safety on this stock. After an earnings report that missed expectations, the stock continued to drop down to $35 and then eventually down to lows around $30. At this point, I should have taken another look into the stock to make sure that nothing had changed significantly from when I initially bought my first shares. If nothing had changed, given the small position size, it would have been reasonable to double down on that position. Instead of doubling down, which would have given me a nice gain on the stock, I ended up selling my shares at roughly $35 per share. In hindsight, this was pretty dumb and I lost $750 on the trade. What could have easily been a couple $1,000s gain had I just increased my position instead of selling those shares on emotion. It's easier said than done, but investing is best when you're as emotionless as possible. If you want excitement, go to the casino, but when it comes to investing, put on your poker face. Now, while I still think it's too early to call these investments a success, I took that lesson from Foot Locker to heart and wasn't scared away from stocks which I believe had significant value. In the case with GameStop, after a sudden earnings drop, which I believe didn't materially change the investment story, I was able to average down at prices significantly below what they're trading at today. Similar story with Newell Brands, although that one took a little bit longer to bottom out. With Newell Brands, I was planning to average down even more significantly should the shares traded below $15. However, we just missed $15, so that additional capital was not deployed. Which is bittersweet because while it's nice knowing that the position is now up over 50% from those lows, it stings a little bit knowing that I was just pennies away from increasing the position further. I don't consider this a huge mistake within itself because I usually set those average down price buy-in targets progressively lower as a risk mitigation tactic. In this case, we just didn't hit the buy order at 15. We won some on the stock that we had, but we didn't win more on the stock that we didn't buy. You get what I'm trying to say. Anyway, if you want to see me do more investing in real time and call out my investment mistakes, you can check out my public stock portfolio that I share on this channel. And there'll also be a lot of content here on this channel, so if you haven't yet subscribed, feel free to join our growing community of investors, almost 10,000 members strong, and I can't thank you enough for your support. Until next time, thank you so much for watching. My name's Michael, and I will see you in the next video.